Welcome to another episode of Estate Planning with Eugene. Do you have clients who have beneficiaries based overseas, particularly in the US? Or clients who have children studying or working overseas, or perhaps are concerned about how their estate planning can take place? Questions like, do they need to incur more tax? Less tax? How would their planning be implicated with overseas beneficiaries in the US? And so on and so forth. Now, according to the Open Doors report in 2021, Singapore has 4,504 students studying in the United States, which is about close to 20% of the total number of Singaporeans studying overseas. And this is evidenced by an increase in US student visa applications. Some of the students furthered on to work in the United States after finishing their studies and getting a green card. So make sure you stay till the end of this video because we believe that you will be adding tons of values to your clients after this session. In this episode, we have John, who is a US tax and estate planning specialist with Butler Snow, and he specializes in US taxation. So today, I've borrowed him, grabbed him here, just to help us to understand more about US taxation. So let's dive right in, all right? Now, hi John.
Hello.
Thanks for coming. It's so privileged.
Thank you for having me. I really appreciate the chance to talk about a complex topic that is very near and dear to my heart, US tax.
Awesome. Now, why don't you just tell the audience, what do you do on a day-to-day basis being a US tax and estate planning specialist and your area of specialization?
So my area of specialization is US tax and estate planning. Tax in the US operates on three levels. There's a federal level. There can also be state level tax issues. And in some places, large cities like Los Angeles or New York may also have a municipal tax system. So my job and my role is to learn these rules and then be able to act as a translator of sorts for clients so that when the time comes for them to arrange their business and personal affairs, they can do it in a way that's efficient and that they don't inadvertently stumble into a bad outcome that eats up more of their wealth than there is a better way to do it.
Okay, so you're an important person, right?
I don't know about that, but I try to be an educator. And I try to take my responsibility as a subject matter expert very seriously, and that sometimes I find myself apologizing for the complexity of the U.S. system.
You shouldn't,
but I want to serve as a good ambassador for the U.S. to explain its rules and why, in most instances, there's a very good reason behind the rule, but it can be difficult for a layperson to understand.
Yeah. Wow. Okay. Great. Now, so are there any trends over the last couple of years, with your experience that you've seen clients having beneficiaries, right, from an estate planning perspective, who are based in the US, and when they are trying to distribute income or inheritance to their beneficiaries, kind of like they need some form of help in that area?
Yeah. I think there are two strong trend lines over the last 10 to 15 years, and these trends are really the entire reason for my career outside of the United States. And trend one would be more and more families sending second or third generation family members to the US.
To the US.
Either to go to school or to start or grow a family business of some sorts. And once that family member has established themselves in the United States, then that can create complications for the family's business operations and succession planning.
Right.
The other trend is, and this one is not as positive, but the US government and the US tax authority has gotten much more aggressive over the last 10 to 15 years in reaching outside of the United States to enforce their laws. So the FATCA, Foreign Account Tax Compliance Act regime, was the first notion that countries should start exchanging data with one another so that the US would know when US persons had accounts outside the US. That trend made it more necessary for US persons who lived outside the US or had accounts outside the US to take proper advice, because now that data is in the hands of the tax authority in the US and they can raise notices or examinations about it.
Yeah, I mean, for those who are listening in, that's the exact reason why, if you have some assets in the US, that's the reason why you have been signing tons of extra forms because of what the US government is doing. Well, so thanks for that. That's a great insight. Now, can you also, John, share with us this difference between inheritance tax and estate tax? Because there's always a misconception. So today we want to debunk these two different tax concepts: inheritance tax versus estate tax.
Yeah. No, it's a great question, and I'm glad you raised it. Those terms are kind of loosely used in the practitioner community to make distinctions about who bears responsibility for a tax in place when there's a wealth transition between the family. Some countries don't impose either. So in some jurisdictions, when an individual passes away, the entirety of what they owned at that point won't be subject to a tax regime.
Like Singapore.
But like Singapore.
Yeah.
But some jurisdictions do. And when you have jurisdiction, for example, the US, that has a tax that's in place, then you need to look at who's going to bear the responsibility for that. An estate tax typically means that it is the person who passed away, it's the estate of the person who died, who is going to bear the responsibility. But typically an estate will appoint someone who's in charge called an executor.
Yeah.
So it will be the executor of the estate that is responsible for taking an inventory of all assets that were held at that moment in time, figuring out what the basis in that asset might be, meaning what was the value that that asset had been acquired at versus what was its value when the individual passed away, and then coming to a conclusion on what tax is owed. That's different from an inheritance tax, where it is the responsibility of the recipients of the funds, the beneficiaries, will bear the responsibility for declaring that they received that inheritance, and then making a payment of whatever percentage of that they received is due as a tax. So that's the big picture explanation of a complicated system, but it's about who bears responsibility.
The giver, which is the deceased, or the recipient, which is the inheritance tax in that sense.
That's right, and it's a concept that I encourage anyone who's struggling to deal with a tax issue is always issue number one, whether it's an estate tax or inheritance tax, or an income tax, or even a sales tax. If you're trying to figure out a tax question, first question is always, who owes the tax? Because that'll often help you if you have to make decisions in interpreting rules or words. If you can always be focused on, okay, the intention of this tax is that person X is bearing the responsibility. It will help you solve those problems sometimes.
Very good advice there. Who owes the tax?
Yeah.
Great. Now, so, in a typical, we are in Singapore, so a typical Singaporean family who is living here, we have been getting requests and concerns that their children or maybe their relatives are currently residing in the US. And I have particularly one client over the COVID season that beneficiary has gotten a green card. So instantaneously, the client would call me and say, Eugene, I need to find out how would my entirety of my estate planning change, because now I am distributing to a US permanent resident, right? So, we're going to tackle more, because I believe many people who are listening in have pretty similar case like that. So, let's talk about this scenario. Let's say David and Mary, okay? So the parents, David and Mary, they have a child, and just one child. And this child, his name is Jake. And Jake just recently got his green card in the US, okay? He's living there, he has studied, and he's going to work there. So imagine for David and Mary, they are sitting down with an estate planner in Singapore, planning out to distribute their assets to Jake. Now, the question here, the big picture is that, will Jake need to declare when finally he receives the inheritance? Okay, but we're going to break it down first into the asset component, because I believe it depends on the asset classes in that sense. So let's talk about shares. Okay, so if David and Mary has say $5 million of shares, stocks, bonds in Singapore, and it's been giving very good dividends over the years, and they write in their will that when they pass on, they want to bequeath this portfolio of $5 million to Jake, who is in the US. Now, John, could you share with us how is Jake going to be affected?
Sure. Well, I think the first place to start, you've described a very common situation. And I'm going to say, unfortunately, you've described a very common situation. Because if we go back to the beginning, hopefully, when Jake got the green card, he took advice before he got the green card. Because before you enter into the US system, you'll have a lot of options to kind of set yourself up better for what will the effects once you're in the system. But as I said, unfortunately, the situation you describe is more common, which is it is only after someone has already gotten the green card that it comes to mind, wait a minute, I need to start dealing with...
And it's too late.
It's not too late. There are still options. We just don't have as many options as we have if we can plan ahead of time.
Can they tell the US government to wait and rewind and then they prepare, or it's not possible?
You can't reject a green card per se, but if you receive notice that you were approved and you were outside when you received notice, then you have some flexibility of what will be your first start date when you enter into the US. But let's set that aside and deal with the heart of the question you've asked. Stocks and securities, okay? Typically, whether or not, as I mentioned, there's an estate tax in the US and a gift tax that follows. So we refer to estate and gift taxes as transfer taxes as opposed to income taxes.
Okay.
All right? So if we're looking at a situation where a non-US family is going to transfer assets to a US person, the green card holder, then we're first looking at what is the nature of the asset. So you mentioned stocks. Okay, are those stocks in a Singaporean company or are they stocks in a US company? Because that's a big difference. There could be estate tax exposures associated with stock in a US company that there wouldn't be for stock in a Singapore company. If instead of stock, they're transferring maybe a family heirloom, a piece of jewelry or a very expensive car, again, we want to look about, is this jewelry in the US? Is it a car in the US? Or is it a jewelry outside the US or a car outside the US? So whether an asset is a US asset or a non-US asset is a preliminary review that we would do, but assuming it's a non-US security. Now comes the phrase I use often that US persons hate to hear, which is, it is never the most efficient thing to give an asset directly to a US person. So that family, once their child moves to the US and gets a green card, it is never the most efficient thing to simply give them $5 million in stock.
And why? Why is that so?
Because once an asset is in the hands of a US person, it's now in the US tax realm.
I see.
I think most people are familiar with the US being unique in operating a worldwide tax system. So once you become a US resident, that means being a citizen, holding a green card. The technical name for a green card is lawful permanent resident. We'll talk about that later, and there's an important reason why that word is emphasized. Or if you spend too much time in the US, you can become an income tax resident simply by your presence there. Once that happens, then it's your worldwide income, no matter where in the world the income is arising, and no matter where you are physically situated when that income is arising, that becomes subject to US tax. So as opposed to the family, the father and mother who don't have as much US exposure, they may have some if there are US dividends involved or US other types of US income. They've got a smaller. Once it gets in the son's hand, everything is subject to US tax, not just a small subset. So it's never the most efficient to give directly to a US person. But giving indirectly can be very efficient, meaning put it into a fiduciary structure, like a trust or a foundation for the benefit of US persons, instead of just putting it directly in their hands.
Right. We'll come to that later in terms of the structure. That's a very good point by John. So never ever just give outrightly to a US person.
I always hesitate to use the words never ever because I say to people, don't let the tax tail wag the dog.
Okay.
Your family life circumstances are more important than any tax situation. If a child needs money for an urgent expenditure, so a medical bill, or to pay for education, tuition of some sorts, the key is don't give them more than they will consume or spend in the next, say, 6 months. Because once it's in their hands, if some tragedy occurs and they were to become ill or pass, now whatever they haven't spent is in their estate with worldwide exposure as opposed to the parents.
Right.
And so you want to try to avoid giving them more than they would immediately consume.
Very good. Not giving them more than what they would need to consume.
Exactly.
Okay, so if let's say now the portfolio of 5 million would be given to the child, Jake, right? Does it impact him in terms of the income tax? Yeah.
So not as part of the transfer. So as I mentioned, the US operates under an estate tax system, and then the gift tax system tracks along insofar as it is the person making the gift who would bear the tax responsibility.
Okay.
So in the situation you described, as long as the gifts are not of US stocks or other US situs assets, then regardless of whether it's occurring during their lifetime as a gift or in their estate, shouldn't be a tax liability owed. There may be a reporting obligation.
Okay.
So when a US person, like a green card holder, receives a transfer from a foreign person or entity, they may have to file some paperwork to say, I received a gift.
That's where the IRS will know.
They'll know that they now have an asset in their own hands. And you mentioned, is there an income tax responsibility? Not as part of that transfer, but from that point forward,
there will
any
be
growth that's income would be chargeable to the US person now and not to the parents. Another reason why we don't want to put it in their hands unless they're going to be immediately spending that dividends and earnings. If it's just going to accumulate and grow in savings, let's keep it in the hands of the parents, because unless it's US stocks and securities paying dividends, there won't be a US income exposure.
In other words, the parents have been receiving dividends, right? Or even capital gains, but there's zero taxation, zero CGT in Singapore. But the moment where they move on and they just give outrightly to child who has a green card, and any income and any dividends would have to be started. They will have to announce and they have to declare, the son will have to declare income tax.
Yeah, and that's an excellent point you raise about capital gains tax. As I mentioned before, I think most people have an awareness of the worldwide aspect of US tax. But it's also the US definition of income that applies worldwide. And so as you noted, I live and work in Singapore, but I'm a US citizen. If I buy a share of a Singaporean stock for $10 and it rises to be worth $20 and I sell it, that $10 gain in capital, Singapore does not treat that as income, and I don't owe income tax to Singapore on that. But because I'm a US citizen and all of my income is in the US tax realm, then I have to apply the US definition. And I do owe income tax back in the US on that. So it is a trap that sometimes inadvertently hits people because they don't realize it's not just worldwide taxation, but it's the US definitions of income that apply worldwide.
Right, that's so good. Okay, now I have a golden question, and I'm sure that everyone who is listening to this video has been trying to find out, like, what is the truth and how do they anticipate or understand, okay? Because I'm sure having US shares as a Singaporean, okay, I have US counters as well. And we talk about the Magnificent Seven over the last few years that have been driving the stock market. But at the same time, I think we are also asking whether in the event of a demise, do I need to pay US estate taxes as a Singaporean? Because I have, right now, okay, I'm not disclosing, but probably about 30%, 40% of my portfolio in the US. So, am I liable to pay estate tax of my shares?
Yes, and that's an unfortunate
no.
outcome. It's an unfortunate outcome in many situations. However, it's often a needless outcome if people are well informed during their life. So let me give you an example. I was once approached by a client who, I think as many people in the world, was intrigued by the Facebook IPO.
Yeah.
And so he had no connection to the US. He lived entirely his whole life outside the US, never went to the US, but he was intrigued by the Facebook IPO. So he bought $5 million of Facebook shares in the original offering. He contracted an illness and passed away holding $5 million in Facebook shares, US stocks and securities. There is a US estate tax exposure for a non-US person, for a non-domiciled person. There is still an exposure if you pass away holding US situs assets for estate tax purposes. So that's a 40%,
40%.
40% of 5 million was lost to estate tax.
So not of the gains, but of the entire value.
Total value. Now,
Wow.
I said it's an unfortunate instance because it can be so easily avoided. A non-US person can hold a portfolio that includes US stocks and securities, not directly in their own name through a simple investment account, but instead in an investment account that's held through a properly set up and run foreign company.
Right.
And there are many reasons beyond tax for why an individual would want to use a company structure to hold an investment account. It helps when documenting and validating the account to most financial institutions. It helps when getting certain writs or confirmations on leveraging. And I think leveraging is something most investors like to try to do. But one of the big advantages from a tax perspective is that a properly set up and properly run company never passes away.
Exactly.
So the company never dies and therefore never owes an estate tax duty. And the individual who will pass away eventually, they pass away holding shares of a non-US company, not directly holding the US stocks and securities, and therefore they've successfully avoided unnecessarily creating a 40% US
So to the
estate
US,
tax liability.
the owner of that shares is forever in existence, and therefore there's no need for estate tax.
Yeah. Now, I do have to emphasize, and this is a recurring theme throughout discussions of US tax, is that there is the idea of substance over form. So that solution is not a simple solution of sign a piece of paper with a corporate name and then I do all the work and all I did was sign a piece of paper with a corporate name. That will probably be looked through as a sham transaction because you're not treating it as a genuine corporate entity. So you need to be careful that you follow all the jurisdictional requirements in setting the company up.
Right.
And then while the company is running, keep separate books, hold annual meetings, treat it genuinely like a company.
Right.
That shouldn't be overwhelming in time costs or financial costs, and it has a great value, particularly if you're going to invest in the US stock market.
Right. And can that company be set up in Singapore?
It can be set up anywhere in the world as long as it's not a US company. Because if it's a US company, then the value of the shares of that US company would be subject to estate tax.
Right. As long as it's out of the US.
Exactly. As long as it's a non-US company.
Okay. Now, so back to that question, right, about Singaporean owning US shares. We've been hearing this, about whether or not the custodian of the firm is situated here locally or whether the custodian of the shares is overseas.
Right.
So does that really make a big difference?
It doesn't. I think that much like any rule, it's only as powerful as its enforcement.
Right.
And the reality of US estate tax over the years has been a reality of a lack of enforcement. And oftentimes, a lack of enforcement can create a dull attitude of a lack of awareness. We joke with people that it works until it doesn't work.
Okay.
And so avoiding a problem or ignoring a problem works until it doesn't work. And so what I would caution people is, while it may not have robustly come to Southeast Asia and the financial institutions here yet, as much as it has in Europe, it is a trend which has only grown over the last 5 years. We're seeing more and more situations where notices or examinations are opened on accounts held in this part of the world, and banks are becoming more savvy. So when a client passes away and the son or daughter or the executor comes to the bank and says, here's the note of passing, I'm the new account holder, can you release the funds to me? Many institutions will look to see what was held in that account, and if there are US stocks, before they'll release the account, they'll say, you need to give me either a transfer certificate from the IRS that shows this has been declared, or opinion from a US counsel that there was no taxes owed. So we are starting to see more situations where the rules are being actively enforced, even though in the past they may not have been.
So it's better not to take chances, right? Because it's 40%. It's crazy.
It is such a large number, and the actions that are necessary to ring fence against them are not that time consuming and not that expensive. It's relatively financially efficient to establish a company and run it properly. And when you compare that to the 40% risk of losing, then it seems like a very simple solution to avoid that problem.
Right. So in other words, what you are trying to say is that it is always good to put things in order, right? And not allow your loved ones to take chances where in the end they will be slammed with a 40% tax. And by then, we would have been long gone. But the taxation rules are still there, enforced.
That's my professional opinion, and what I always try to convey to clients when I'm having a discussion, and I'm sure you do this as well, it's not our job as advisors to take decisions for clients, but it is our job as an advisor to make certain that when a client takes a decision, they have all the relevant information. What I hate as an advisor and would never want to happen is for a client to take a decision and then years down the road, when the consequences of that decision happen, for them to find out, well, wait a minute, if I'd known I could have easily done X, Y, and Z, I would have done X, Y, and Z.
So good.
No one told me. I like to be the person that tells them so that they can take that decision with all the relevant information.
Totally agree. I think this is a very, very important part in terms of the professionalism, right? That we owe a duty of care, in that sense, to the client.
Yes.
All right, thank you so much. We have kind of like debunked the first aspect of stocks and shares. Now let's move on to the second aspect, which is on properties, because we can never run away from properties when it comes to estate planning. So David and Mary, back to the earlier scenario where they own a private apartment in Singapore, okay? And not just one, but they have probably another apartment that is collecting rental income, and they're owning it in their own name. So when both of them move on, typically, the usual scenario is to just pass the property to Jake, who is living in the US. So how would this change? You're talking about it's a worldwide income. Now, will Jake need to declare that now he's the owner of this property in Singapore? And what will happen to the rental income?
Yeah, so from a rental income perspective, if Jake is the owner of the property and the property is generating rent, then he's going to have to include that as income. That meets the US definition of income. He'll have to include that as income on his tax return. Will he need to declare the asset? Typically not. There's not as many situations where a declaration is necessary when you deal with real estate as opposed to bankable assets.
Right.
Typically, bankable assets in an account of some sorts would need to be declared on either an FBAR, Foreign Bank Account Report form, or Form 8938, statement of substantial foreign assets.
Right.
It's focused on bankable assets. So there may not be a declaration that needs to be made in regard to the owning of the asset, but it is going to create complications from the rental income perspective and also from a capital gain perspective. So the parents could have sold that property and given the proceeds that would then not be subject to a capital gain. But if they don't do that, and if the property was not exposed to U.S. estate tax, there might be an embedded gain that is put over to the U.S. person recipient needlessly.
Right.
So we need to be careful with that. The last thing to mention about immovable property like real estate as opposed to bankable, it's far more likely that once you're dealing with property, you're going to have a local tax consequence that needs to be balanced with the US. As you mentioned with Singapore, Singapore has a very light touch on income taxation.
Yeah.
No capital gains, not as many complications to coordinate with the US system. But that's not true with property. Once we're trying to take decisions about what's best for the US person's son, well now, can we put that in a trust? Well, if it was cash, it's easy.
Yeah.
But if it's property in Singapore, putting it into a trust or a company structure can get quite complicated.
Yeah.
When dealing with property, you're putting in a lot of complications with the US system, but you're probably adding even more in the local jurisdiction where the property is located.
Get you. Well, that's quite amazing, right? I mean, so in other words, when they receive the property, it adds on to their estate duty, their estate taxes in the event of a demise.
That's right.
But at the same time, the rental income that they've been collecting, they have to declare it. And if they sell off, there's a capital gains tax.
That's right. They
In
may
their
have to
lifetime.
go back to a point, if there wasn't proper planning done, they might have to go back to a point in time before the parents passed away to determine the original acquisition value. And that value and the current fair market value when they sell it determines that capital gain
gains tax.
exposure. And so with proper planning, we can try to make certain that whatever the fair market value was when the parents passed away is the starting point for any further capital gain exposure.
So important. So with proper planning, you don't have to backtrack all the way to the time where the parents purchased that property. That's so important because
That's right.
properties appreciate over time.
Yes.
So over 10 years, easily properties can appreciate at least about 30 to 50% for some. So that would be so much of a extra taxes that they'll be paying.
Yeah,
right?
and it's a needless exposure. Again, it's one of the ones I feel most apologetic about is if a family comes to you and mother and father have already passed away, we don't have as many options. But if we can talk to families who intend on benefiting U.S. person children with property before they pass away, structure their will or a trust planning properly, then we can be very efficient and not needlessly bring an asset into the U.S. system.
Right, understand. So we've covered property, which is the second asset class. So we covered the first one on stocks and shares. Second asset class on properties. We come to the end of the last asset class, which is on life insurance. Okay, it's a very, very exciting topic. Okay, so here in Singapore, there are many parents that purchase policies on behalf or even for their children and even putting their names and making them life assured. So the question here is that of late there are also policies that do not just give a coverage but they also give returns.
Yes.
There'll be an investment element and they give returns and to what they call the investment link or unit link insurance policies. So tell us, John, if let's say the child is right now a US green card holder or what you call a lawfully permanent resident, right? I remember it correctly. So how would it impact? There will be returns, there'll be paying out for dividends from that unit-linked investment policy. How does it impact the beneficiary?
Okay. So the good news is insurance in the US system is recognized and is one of the most efficient planning tools to use for multi-generational transfer of wealth. That's the good news. Most people that have conversations with me, when they hear me mention good news, understand that what's probably coming afterwards is there's going to be a caveat about bad news. And the caveat with insurance is The US has a very strict definition of what is insurance. So the first thing we have to do when analyzing whether an insurance product is going to be efficient and useful when US persons are involved is we need to figure out, is that treated as insurance under the US system? Just because something is labeled insurance outside the US doesn't necessarily mean it will be treated as US in the US system. So lots of efficiencies in the use of insurance, but the threshold, the gatekeeper question has to be, is this actually an insurance product under the US rules and definitions?
Right. So how do you know whether it's under the US? Does it fit the bill of the US approved life insurance? How do you know that?
Sure. There's a technical answer and there's a practical answer.
Give us both.
I'm going to start with the practical answer because I like using shortcuts if you've thought through and you're not cutting off information. This is one of those shortcuts that's been thought through and is the most efficient way to do this, which is you ask the provider or you ask the broker. So most people, when looking at purchasing an insurance product, they're going to be dealing either with a broker or directly with the issuer of the policy. So that's the easiest way, is simply ask them, is this a US compliant policy?
Right.
They should be able to give you an answer. So if you get a yes or no, then you've shortcutted the discussion. So you can either, if the answer is yes, okay, great. I can rely upon insurance treatment to have an efficiency, whether that's capital treatment of the payout or deferral of the income as arising for payout in the future.
Yeah.
If the answer is no, this is not a US compliant policy, then you can pivot to a US compliant policy or to an alternative investment because you know that the virtue of that investment that's being shown to you may not be the same because of the US rules that might treat it differently.
Right.
So yes, no there helps us shortcut it. Unfortunately, sometimes the answer to that question is we don't know.
Yeah.
So now the technical analysis comes in. You would find an actuary under the US system to analyze the policy. This is an oversimplification, but I think it will help clients to understand what you're looking for and the difference between insurance and not insurance. The US definition is highly dependent upon an insurable interest and a calculation of premiums versus some connection to morbidity and mortality table for that person.
Right.
So they need to see that this is genuinely an insurance product. You're going to pay a premium, and then I'm going to look at how old you are, what your health is, what your gender is, and I'm going to calculate what your potential longevity is, and you're going to have a return over that amount of time, and then it's going to pay out X based upon that. Some non-US policies don't necessarily have a strong connection between premiums paid and the life of the person insured.
Which is the mortality.
They're more of an investment product. You're going to put in X, you're going to earn 10% earnings, and so while it calls itself an insurance product, it's more like a mutual fund or a private equity investment that's giving you a rate of return.
Right.
So under the technical definition, you can engage with an actuary to analyze the policy that you're being sold. Look at the premiums, look at your life, make sure that there's an insurable interest here, and that they could confirm yes or no, this is or isn't a US policy.
So good.
Oftentimes, the cost of that is prohibitive for all but the most ultra high net worth clients.
Right.
Because you might be looking at $75,000 to $100,000 in analysis costs to come to the conclusion. So oftentimes, if you can't get a yes or no answer, then the best thing from a practical perspective is assume no and pivot to an investment which you have more certainty of the treatment and the outcome.
Yeah, that's so good. I think when we talk about insurance policies, generally from the US perspective, it's very common that people look at the PPLI, private placement life insurance, that is for sure for tax efficiency in terms of wealth distribution. So in other words, if you are, if you have a policy that's a non-US approved, every return, every dividends that's being paid out will generally be an income to the green card holder, Jake, in the US, and he has to declare based on his progressive tax rate,
Right.
if that's what they're saying. But if let's say they structure into an insurance product that's a US compliant, it's a PPLI, for example, every payout will be tax exempted.
Could be. It depends on the nature of is it an individual or an entity that's holding the policy? But in general, your understanding is correct.
Great. So that means that there's a lot to be done, from a perspective of an individual who has a beneficiary who is in the US, because we are just expecting returns, right? Passive income, we're talking about long-term annuities and all that. But imagine the money coming out is going to be taken by the the authorities. So there's some restructuring that's required to make sure that it's very tax efficient, right?
Yes.
Okay, so I have a question, John, maybe you can help us with that. Some clients or some advisors are asking that doesn't matter if, let's say, the money is being remitted into the US or it stays in the bank account in Singapore, that they are not aware. Is there a difference in that?
The simple answer is no, because as we mentioned, once something is in the hands of a US person, citizen, green card holder, or substantially present person, an income tax resident, once it's in their hands, then it's worldwide exposure. It doesn't matter where the asset is, it doesn't matter where the income is being generated,
Right.
It doesn't matter where that person is physically located. So the simple answer is no.
No.
Now, around the edges, there are minor distinctions. You heard me mention earlier a form called the FBAR,
Yes.
Foreign Bank Account Report.
Yes.
There are many acronyms in our profession, and it can be overwhelming. But this is a good one that if you learn the acronym, it explains itself. Foreign Bank Account Report is exactly what it is. It's where a US person like myself reports all the foreign accounts that they hold, so accounts outside the United States.
Right.
So there can be a difference in whether money is remitted into the US or kept out of the US in the forms that you need to file for declarations, but not a distinction about the tax that you're paying, because you're going to owe on that income regardless of whether it's kept outside the US or brought in.
Get you. So good. So in other words, it doesn't matter, because from a US angle, everything is included.
That's right. The
Okay.
US operates an anti-deferral tax system. They have lots of negative rules to disincentivize any US resident from holding income outside the United States and not including it annually on their income tax return.
Yeah.
So there's rarely, if ever, a situation where keeping funds outside the US would be advantageous.
Yeah.
Now, if mom and dad are still alive and keeping the assets outside the US in their hands, that can be advantageous. Or
see.
keeping the assets outside the US in a US compliant PPLI policy, that can be advantageous. But the general thought of, I'm just going to keep this money that's mine and I can get access to, I'm going to keep it outside the US and it won't be a problem for me,
It won't work.
that's not true.
Okay, great. Now, very quickly, coming to gift taxes, annual gift exemption. We've been reading. If you are into the US taxation, you probably would have read about the annual gift exemption limit, right? So, John, tell us more about this gift tax and exemption, and how can one make use of this, I would say, opportunity, right?
Sure.
To give something to their loved ones.
So we talked about this, we touched on this earlier with non-US persons, when
Yeah.
mom and dad were giving a gift to a US person. The US gift tax system operates where the giver, the person making the transfer, is the person who would have the tax exposure. So if non-US persons are making transfers, we don't need to worry about exposure unless they're gifting US status assets.
Yeah.
But once you have a US person who's making a gift, like myself,
Yeah.
or Jake in our scenario,
Yeah.
Jake's gonna have both annual and lifetime exclusions to use.
Okay.
Those exclusions operate to really mean that most Americans will never pay a gift or an estate tax. So annually, every US person can give gifts to every other person in the world up to $18,000 annually without having to file a form or pay any tax.
18,000
So
annually.
I could go to every single resident of Singapore and give them $18,000 if I had it, and I would not owe a tax and I would not have to do any reporting as a US person.
18,000 per
person.
annum, per person,
Per person per year,
per year.
okay? Even above that, so let's say I have a certain amount of friends that I like even more than just the general people. I want to give them double that.
Yeah.
Well, even if I go above the annual exclusion, I now have my lifetime exclusion to draw down on.
Right, right.
And that is currently $13.6 million.
right.
So most Americans will never accumulate 13.6, much less give that away
Right.
during their lifetime. So they won't need to pay a gift or an estate tax. Now, when you're using your lifetime exemption, there are forms to file. And this makes sense when you think about it logically. If you have a lifetime exemption,
Yeah.
once you reach the end of your life and the IRS or the tax authority has to determine your liability, they need to know how much of that is left, how much have you used up during your lifetime. So if you're using the lifetime exemption, there are forms to file to say, I used 1 million of my exemption to make a gift.
Right.
But there's no tax owed until you get to that 13.6 million.
So does it make sense as I'm just thinking aloud, if I'm a US citizen, before I know that I am going, I will just, and there's a 40% estate tax, right, to be paid on my estate. Does it make sense to utilize my lifetime gift exemption and start giving away before I move on?
Yes and no. So it's a combined gift and estate tax lifetime exemption. So I don't have to give it away during my life for it to be exempt. So if I were fortunate enough and I have a good career and I accumulate 5 million in assets and I pass away, I don't have to give that 5 million away during my life to use the exemption. When I pass, that will apply to my estate, and I will not owe taxes as long as I have less than the threshold. So you don't have to give it away. However, there can be some timing opportunities.
Right.
In this day and age, we all have heard of startups or cryptocurrencies which go up in value quite large, in large amounts. So you can make effective gifts during your lifetime, but utilize more than the exemption. What do I mean? Let's go back to the example I gave of the individual who bought 5 million of Facebook shares.
Yeah.
If that person, rather than keeping that in their own hands, had made a completed gift trust, an irrevocable trust, they completed a gift into it for the next generation, they would use up $5 million of their exemption making that gift. But over the rest of their life before they passed, let's say that those Facebook shares became worth 20 million.
Yeah.
If they'd kept them in their own hands, everything above 13.6 would have been subject to 40% tax.
Yes.
But by making the gift and using 5 million during their lifetime, when it's 20, it's already out of their estate and it's gone on to the next
it's a
generation.
timing issue, right?
The timing can be very helpful.
What a good point.
To make gifts during your lifetime, not to avoid the exemption, but if you believe that your total net worth will go above the exemption by the time you pass away. And all of us should hope that our net worth will go above that if we invest. So it's a smart planning technique to use.
But
for
you lose
some
control,
portion.
right?
You do have to give up
The
control.
trade-off.
As I mentioned earlier, the US system operates substance over form. So it can't be, well, okay, I made a gift, but I'm still controlling it. No, that's not genuinely a gift.
That's fair.
So this would be, if you reach a point in your life where you have enough to take care of yourself, but you know you've got more that will be for the benefits of multiple generations down the road, you might go ahead and make a completed gift at that point.
Okay. That's something new to know, but that's also a good point that you made about gift taxes. And I heard from you earlier that the 13.6 million, you will trend downwards a little bit, right?
That's right. So in the tax code, in the legal language, the exemption says every US domiciled person gets a $10 million exemption adjusted for inflation. So that 10 million, if you apply inflation, gives us the current 13.6 million. That language in the law will change in 2026 absent legislative action.
Okay.
It will automatically, the language in that code section will now read, every U.S. domiciled person has a 5 million exemption adjusted for inflation.
Okay.
So it will roughly be cut in half. At that point in time, it will probably be about $7 million exemption.
Okay, so you would be lower in that sense.
Yeah, so there's planning opportunities over the next 2 years for any U.S. persons. You got about 5 to 6 million in value that's use it or lose it.
Right.
Go ahead and make gifts now because you're not going to have that exemption after 2026 most likely.
Okay, that's a very good point for us to, in the next 2 years to consider giving money away, and giving money, it doesn't matter whether it's a US domicile or non-domicile, right? To the recipient, it doesn't matter.
No, I mean it does make a difference whether the giver is domiciled or not domiciled.
Right, but
whether the recipient is domiciled or not domiciled, it doesn't make a difference for a tax owed, but always going back to that first principle of thinking about when we're analyzing tax, who's gonna owe it?
Who's gonna owe it?
And once we put it in the hands of a U.S. domiciled person, it's them that's gonna owe it. And if I need to get rid of it, I'm gonna have to use up some of their exemptions. So if I can avoid putting it directly in their hands, but still allow them to have some benefit from it, that's the optimal planning.
Optimal planning, very good. All right, now the last question that, thank you, John. You've been really helping every audience here listening into understanding US taxation in a very plain vanilla method. So, the last thing that I want to ask you is this, about trust. We've been hearing so much about having structures like trust to help clients to minimize taxation, and not just about tax, but it's also to distribute over a couple of generations later on, and that's the whole idea about trust. But we hear this thing about grantor trust. Maybe you'd like to add some light to help us to understand.
Sure. Trusts are a very powerful planning technique under the US tax system, similar to what I mentioned about life insurance. So trusts can receive very preferential treatment. When we're analyzing trusts, I think there are two important things to keep in mind. First, the residence of the trust.
Okay.
The US divides trusts into two types, US trusts and non-US trusts.
Okay.
So a US trust is defined as a trust that passes the court and the control test. Court test is simple. Do US courts have jurisdiction over the trust? The control test is a little more complex, but it's basically, do US persons have control over all the decisions of the trust? So right away we know you've got to have a US trustee for it to be a US trust, and all the power holders, the settlor, the executor, anybody who has power would probably need to be a US person. So it's common for a trust not to meet those rules, and so they're treated as a foreign trust, non-US trust. Similarly, like you just mentioned, from an income tax perspective, the US divides trusts into two types, grantor and non-grantor.
Right.
Grantor, similar to a word that we see used outside the US, settlor. So a grantor trust is a type of trust where it is the person who settled assets into the trust that retains the income tax responsibility, as opposed to a non-grantor trust, where it is the beneficiaries of the trust who have the tax liability.
Right.
So in the situation you described, where mother and father are non-US persons, and son is a US person, it is advantageous to have a grantor trust, because mom and dad settled assets into the trust. If they remain responsible for US taxes, it's a smaller amount of exposure. Their only exposure to US income tax would be if the assets in there are producing US sourced income.
Right.
Whereas if the beneficiary, the son, a US person, if he's responsible, it's all the income being generated,
that's
no
a
matter where
non-grantor
it is. That's a non-grantor trust.
Right.
So grantor trust planning, when you have a mismatch between non-US persons and US persons, can be very efficient.
Right. In other words, you're saying that mom and dad are Singaporeans living out of the US, assuming the assets are not in the US. Jake, who is the beneficiary only son, is a green card holder. So with a grantor trust, you are essentially telling the US that mom and dad will be responsible, right, in the trust structure to take care of whatever taxation liability that's out of the US. And that means that Jake, being the beneficiary, would have no tax obligation.
From an income tax
From
perspective,
income tax.
That's correct. An even better advantage of that, or a more important advantage of foreign grantor trust planning, is on the estate tax side.
Right.
US persons like Jake and myself, we can use those rules I mentioned earlier about making a gift and using up part of your exemption to skip one generation and save estate tax. But if we try to go to a second generation, the US has something called a generation skipping transfer tax. That locks in. Non-US persons are not subject to that. So that foreign grantor trust that provides income tax efficiencies, if properly structured, also provides dynastic estate tax protection.
Well, I love it.
The assets that stay in that trust avoid the 40% estate tax at multiple generations.
Multiple generations.
That can be tens to hundreds of millions of dollars if mom and dad establish a trust and the family then stays in the US for multiple generations.
Right, and that's the direction of most generational giving, because they would want their inheritance to benefit not just for one generation, but even beyond that, right?
That's right.
So grantor trust is such a powerful tool.
It can be a very, very powerful tool, but selfishly, I guess I have to add, only if you get proper advice and you do it in the right manner. You don't want to make a mistake that will inadvertently cause you not to receive the full benefits.
Right.
I would never selfishly say everyone needs to speak to me, but I would selfishly say, do please speak to a US advisor of some sorts to make sure that the planning you're doing is structurally sound. There's lots of benefits, but it's also complex rules, and if you get something wrong, you can lose those advantages.
Yeah, and it involves tens or even 6 digits, right? If you're talking about savings,
very quickly can add up.
so it makes more sense to have someone who specializes in the tax laws, like John, for example. Yeah, you know, John, it has been a great pleasure having you with us today. I think you have really answered so many important questions that I would guess the audience are all very particularly interested in finding out, and you know, you guys have a treat. And without that, I will not hold you back. I just want to thank you so much. Now, for some of you who feel that you are in a situation that, you know, you may need some advice, or you may just need someone to come out, like give you an overview of what are some of your exposure, John is actually fine and is open for free preliminary consultation over Zoom or Teams meeting. So, you know, what you need to do is just to make sure that you head on to the link below. You will be able to find John's contact, and just feel free to hit him up, because he is someone that has added tons of value to most of our clients out there. So with that, I'll see you for the next episode. Thank you for tuning in.